So I'm sure many of you guys have heard the news about the big, beautiful bill. And although I'm not personally a fan of adding anything to our current $37 trillion deficit that the US continues to add to, there is something that is being added that if you do plan to have a baby in 2025 or later, you could possibly benefit from it. So why not just explore the idea of how to work with it instead of not even knowing about it? So for those that do not know what it is that I'm talking about, one of the many things, I think the big beautiful bill is like 1,000 pages. So please feel free to do your own due diligence, but it says one part of this bill is that every US child will receive a $1,000 S&P 500 starter account at birth once President Trump signs the BBB, which is the big, beautiful bill. So again, do I think that now everyone should be having kids just because of the $1,000 incentive? No, but I really hope that by planting that seed early on for those, especially nowadays, I feel like parents are just much more proactive. I at least maybe just based off of who it is that interacts with me, it seems like parents are being a little bit more interactive with the conversations that I have with people, different people that follow me, that hopefully this could be something that you can continue to contribute to. And I wanted to lay it all out for you. So not only are we going to talk about, obviously some of the terms when it comes down to this $1,000 S&P 500 starter account, but also what it could look like over the next 30 years. Now, again, this isn't something that necessarily, you just funded $1,000, you don't touch it in 30 years and it becomes $1 million. That's not what this video is about, is that there is, an option that you have if you do have a kid that you can take advantage of this incentive of $1,000 and hopefully you can make it into something good. Because we all know at the end of the day, even if it were to be $1 million, maybe 30 years from now, some people would say that, oh, $1 million isn't going to be worth much in 30 years. But having $1 million versus not having it, as parents, all we can try to do is to give our kids the edge to the best of our abilities. If that's $1,000, $10,000 or $100,000, whatever it is that you can afford. But I think that this can really break it all down for you. So again, I really hope that I earn your thumbs up. Hopefully this can motivate you and encourage you to create a plan for yourself that meets your goals and hopefully your future kids' goals. And feel free to share your thoughts down in the comment section. So first off, the bonus establishes the Trump accounts, originally called the MAGA accounts, or money accounts for growth and advancements, which are tax advantage savings accounts designed to give newborns a financial head start for future expenses like education, home ownership, and starting a business. Not bad. So the federal government provides a one-time $1,000 contribution to these accounts for eligible newborns. So again, I don't believe anyone should just be having kids because they get $1,000 contributed. Because again, it's not something that you're going to necessarily have access to right away without penalties. And obviously, it's going to cost a lot more than $1,000 for the lifetime of a kid to have a kid. So, but again, if you're already planning on having one and growing your family, this is just the way, in my opinion, that you plant a seed, you create a proper plan, and that you continue to water, right, that seed into seeing what it can grow to. So eligibility, available to all U.S. citizen children born between January 1st, 2025 and December 31st, 2028, with at least one parent who has a valid Social Security number. In some descriptions, eligibility extends to children under 8 years old as of bill passage, but only newborns receive the $1,000 federal contribution. Accounts are automatically enrolled for eligible children, managed by banks or investment firms, and operate like a traditional investment account. So again, the thing that I really like about this is that it's supposed to really just set your kid up years from now. So hopefully it's something that, again, you can plant, you can water as time goes on, but almost kind of forget that it's there, but you're just consistently contributing to it. And I think at the end of the video, you'll really understand why, because of how much it can grow to, especially in the last 10 years of this form of contribution. And again, we'll make sure that we talk about that. So contributions and growth. Parents, relatives, and other taxable entities can contribute up to $5,000 per year in after-tax dollars to the account until the children reaches the age of 18. So again, $5,000 obviously would be the goal, but even if you could only contribute let's say it's $100. Some is better than nothing at all. So everyone's that's watching this video and that actually plans to do it, the biggest thing is that you put a plan in action. It doesn't matter if it's $50, right? The way that I view it, and I'm going to be sharing the way that I would see to be, in my opinion, one of the best ways to kind of really try to maximize this is that even if you could only do like $50 or $100 a month, it really doesn't matter, right? As long as you're consistently contributing to it. And I guess I'll talk about it more towards the end of the video, but it's how I currently manage my daughter's account. And this really just excited me because also I plan to have a kid. We're expecting our baby boy October of this year for 2025. So yeah, the $1,000 can help. The initial investment that I started my daughter at is a little more than that. But the biggest thing that will make a difference is not just the initial contribution. Of course, everyone's in a different financial position, but it's consistently contributing to it, month after month, year after year, over a long period of time, and especially during downturns. That's one thing that I'll talk a little bit more about, that if you're a parent, if you're watching this video, it shows that you care, and it shows that you at least want to have some form of like financial literacy. And I think the way that maybe I share my plan with you, hopefully you can cherry pick what you like and what you don't like about it and maybe implement it if it fits your plan as well. So funds are invested in a diversified fund tracking the U.S. stock index with earnings growth tax deferred. So a Milken Institute reports that an estimate of $1,000 initial investment could grow to approximately $8,000 over a 20-year broad equity index fund, assuming average returns, which is about 10%. And that's if you don't really contribute anything to it. So withdrawal and tax treatment. So withdrawals begin at the age of 18, with up to 50% of the fund available for qualified expenses, such as, again, as we previously talked about, buying your first home for the down payment, education expenses, capital to start a business. So again, that all makes sense, right? Qualified withdrawals are taxed on long-term capital gains, which is obviously significantly lower than ordinary income tax. Non-qualified withdrawals for purposes other than what those are listed are subject to an ordinary income tax of about 10%. That's fair, right? So at the age of 25, account holders can access up to half of their funds for qualified expenses. And at the age of 30, the full balance can be withdrawn for any purpose. The thing that I like about this is that I just really hope that it can be the spark that parents need to plant that seed and to watch it grow. Because now that this is available and now that you're all watching this and that you are aware of it, is like, yeah, you're right. $1,000 isn't going to change this child's life. No question about it. But it's just implementing healthy habits, especially in the very beginning, which I think can grow into something much greater than that initial investment of $1,000. So funding and fiscal impact. The program is funded through and targeted reforms in the OBBBA and throughout specific funding mechanisms are not detailed in the source. The Committee for a Responsible Federal Budget estimates that the Trump accounts would add $17 billion to the federal deficit over the next decade. And this is where the concern comes of, is this contribution of $1,000 per every newborn actually worth it to be adding $17 billion to our national deficit? But again, the bill's most likely going to pass. This is something that is going to get passed. So what I've learned is you can continue to complain about it or you can just work with it. So what I began to do is I went on Investing Pro and I asked it a very simple question. So if I invest $1,000 with a 10% return, which is the average return for the S&P 500, and contribute $100 a month, how much would I have after 30 years? Because 30 years is when it would become fully matured and you can do withdrawals at any with any purpose with no penalty, right? According to what those terms were. You'd end up with approximately $226,000. So again, with $1,000 and consistently contributing $100 a month, you'd end up with $226K after 30 years. Now again, I get it. What's $226K worth in 30 years? Especially with inflation, the value is going to be significantly less. Trust me, I get that. But having $226K 30 years from now is going to be much better than not starting early, not having anything, and then at that point, you're not really in a position to be complaining about, oh, I only have 226K. What could I really buy from it? Is at least you have it, right? And again, everyone's in a different financial position. So you shouldn't stress out even if you could only put $50, right? Or maybe you are someone that can contribute the full $5,000 every single year, right? With your friends and family that maybe contribute to your kids' fund as well. It doesn't matter. Everyone's in a different position. But the thing that I would say would be most important is that you're doing your part to the best of your ability. And I'm sure that your child will really appreciate that at the end of the 18 or 30 years. And again, why overcomplicate it about the what ifs, or what if it's not what I originally, the numbers make sense. We all know the growth potential is there. It's just staying consistent over a long period of time. And then I asked this another question. I asked, what if we switched this to a $5,000 annual contribution at 10% return yearly, so compounded yearly, for the next 30 years? You'd have an ending value of $904,000, so nearly $1 million if you contribute the full $5,000 every year, especially for a lot of you that have businesses. It's something where if your kid can be contributed to that business and you can contribute the $5,000, again, something to take into consideration. And the following question that I asked was, how does this break down, visually? This is what I wanted you to be able to see, that within the first 5 years, your total contribution is going to be $26,000 and your projected balance is $34,000. You might be like, man, this really isn't the growth that I expected. Within the first 10 years, now you've contributed twice that, $51,000, but now you're at $89,000. Okay, not bad. Within 20 years, you've contributed $101K, but now you're at a balance of nearly $300,000. And look at the last 10 years, from 20 to 30 years, you've contributed only $50,000 more, from the 101 to now 151, but now from nearly 300, you're at 900. This is again where compounding at especially the final 10 years really makes a difference. And the thing that I wanted to say about this is well, how would I approach this, right? I'm obviously, man, I want to say this in all we can do as parents is, if you can contribute the $50 or $100 a month, it really doesn't matter, right? You should be contributing to the best of your ability, that during financial hardship, it doesn't put you, in a stressful position. I think that's the most important thing to take into consideration. But the best thing that we can do as parents is that we are at least trying. So the way that I view it is that for my daughter, I already have an investment account for her. But on top of that, I have a CD account. And anytime, like right now, markets, in my opinion, are incredibly overbought. They're not good deals, right? They're almost at all-time highs. I don't think it's very smart that if I just had a kid and let's say I wanted to fund his investment account for $50,000, to fund $50,000 right now, knowing that markets are at all-time highs, and if markets do pull back, it's going to start off maybe with a retracement. That's just me, because I pay attention a lot to the market and my risk tolerance. I just don't want that exposure, right? So one thing that I can do is that by having both a CD account, which you don't have to, but also having an investment account, is I have the investment account that, I have a specific dollar amount and a specific amount of money that I always want to have invested, right? But as it comes down to contributing more, if markets are at all-time highs, I really don't want to contribute at these overbought levels. So I can invest it into a CD account, which is a much lower on average return, so 3 to 4% annualized. But let's say that it's $10,000 or $20,000 that I have in that CD account. Let's say all of a sudden, just like we saw a few months ago during the trade war, markets began to retrace. So I'm sure a lot of you guys saw this. Markets began to retrace. We saw a consistent downturn, and I loved it, right? Because when markets began to sell off, I closed out and realized that CD account for my daughter, and took those funds and just invested into QQQ, NVIDIA, Apple, and you don't even have to overcomplicate it that much. Those are individual companies for Apple and NVIDIA. You could even just jump into QQQ or SPY, which is the S&P500 ETF, or the NASDAQ ETF, which is a basket of companies, right? So instead of being fully invested into individual companies, you can be diversified into basket of companies during a downturn. And in my opinion, I would rather be someone that continues to fund the CD account at these overbought levels, to wait for an opportunity like this when it's sold off, so then I can take those funds, invest it during a downturn, and then as markets recover, that account is able to really benefit from not just an average of a 10% return, but then be able to benefit from, again, when real deals are presenting themselves, and experience a much more, on average, larger return. So it doesn't mean that you shouldn't be contributing consistently every single month or every single year into that fund. All power to you, right? But at these very overbought levels, I don't think it's going to be very strategic of me to invest heavy at those levels. So let's say that my intention is to invest $5,000 or $10,000 every single year into this fund, but I see markets are at all-time highs. I'm going to still contribute to it, but just at a much more calculated and lighter position. So then if markets do begin to downturn, I can take the funds out of that CD account, put it into that investment account when deals are actually presenting themselves, and then reap the benefit of that downturn of those deals. And then as markets recover, then again, I'm able to actually benefit from that recovery. Just like Warren Buffett says, is be greedy when others are fearful and be fearful when others are greedy. I have no intention of selling any of her positions as markets recover or hit all-time highs. That's the point of being invested long-term. But the whole idea is that, well, when do I want to step on the gas? When do I really want to pour money into the market? And in my opinion is when these downturns begin to present themselves. And the thing that I love about this is that I also wanted to show you is over the past 5 years, markets are consistently bullish, but there are often these retracements along the way. And that's the part that's really exciting, is that if you're ever questioning when should I really invest, not only for myself, but maybe for my family, is that I think investing consistently over a long period of time is very, very important. But I think when you pay attention to these to the markets as much as I do, it's really exciting to have money on the sidelines when markets begin to downturn, to be able to take those funds and just take advantage of those deals. I think that's the best way just that I can put it. And especially if you're watching my content, it shows that you care, and it shows that you're taking time to show interest and intention in doing so. And again, I think that that's the best of both worlds. It's great to want to do something, and it's great to see these specific things being offered that could be incentives for newborns. But at the end of the day, it comes down to consistency over a long period of time, and that requires action. So again, you guys let me know down in the comment section what you think about my plan, and also how I was able to break down one of the incentives of this big, beautiful bill. So even if it sparks one person's interest, one parent's interest out there to kind of get this going, I'm really excited to see and what this can mature to in the next 18 to 30 years from now. So again, also we are offering our 4th of July sale. If you're someone that wants to kind of dive a little bit deeper into being involved in the stock market, I trade live every single morning. I don't just post trade updates. I don't just, oh, here's how much I made today or here's how much I lost. You get to actually watch me trade live every single day. And for 4th of July, we're offering 50% off. So I think it breaks down to less than $1 a day to be able to join LPP. It's a one-time payment, lifetime access. It's the biggest discount that I've ever offered, and it's 50% off. So whenever it is that you feel like you are ready for the next 24 hours, it's 50% off, less than $1 a day. It's a one-time payment, lifetime access. And yes, not only do you get access to the live trading, but you also get access to the A to Z video lesson library that's designed for complete beginners. So even if you don't know anything about the stock market, that is the whole point of LPP, is to take you from the very basics. So once you finish the course, if you take time to actually review it, is that you'll have a much better understanding on how to invest or trade in the market. Now, do you need LPP? No, of course. You can learn everything it is that I talk about yourself through trial and error. But if you're someone that learns best by structure and by watching other people do, then that's why we created LPP for you. So I appreciate your time. That's that second link in the description down below. And like always, let's make sure that we end the year on a green note. Take care.